Glynn, June clearly brought with it a slight change from the recent reasonably benign market conditions we've become used to. What were the main factors at play?
Yes, it was I think will prove to be, when we look back, a very significant month. I think we had confirmation in June that we've seen the end of the 32-year bull market in bonds. And I think the really big issues were all about the Fed and tapering of its ultra-loose monetary policy, QE, and also events in China, where there is quite clear evidence of quite a significant slowdown going on.
Let's talk about the Fed first then. The taper tantrum, as it's been dubbed in the press. Is that a surprise to you, how the market's reacted?
It's a surprise how the market's reacted. It was a given that at some stage the Fed would rein in ultra-loose monetary policy. It had made clear that it would only start to rein it in when unemployment reached 6.5% and inflation was 2% and sustainably at 2%. I think the intriguing thing about what happened at the Fed meeting on June the 19th was that they revised their forecast for unemployment. So within the next couple of years, they now think unemployment is going to be usefully below that 6.5% threshold. They revised down their inflationary forecasts. So for this year, they look at inflation of only about 1.2, 1.3%, and they expect it to be 2% or below over the next 2 or 3 years. So both those pointers are very significant, because that's pointing now towards the triggers for an end to the QE program, where they've been buying assets, treasury bonds and mortgage-backed securities at 85 billion a month. So what the Fed said is that they would probably start to taper, to reduce the asset purchases on a monthly basis before the end of 2013, and then complete the program, end the program in the middle of 2014. The market has taken that to mean that the Fed will start to taper in September, and is expecting the Fed to end the program in the middle of next year. The market reaction was definitely, I think, quite a surprise in that there was an immediate, quite sharp rise in bond yields, in treasuries, and of course therefore across the world, because treasuries are ultimately the security at which other bond markets are priced off, and quite a sharp drop in equity markets, a particularly sharp drop in those markets that have become very dependent on the excess liquidity of the past couple of years. So things like gold fell 10% immediately. Other commodity markets fell very sharply. Emerging market bonds, very weak. Emerging market equities, very weak. So, yeah, I was a little bit surprised. Having said that, it was not a surprise the Fed's going to start to taper in due course. And it was not a surprise to us that we're getting a setback in markets. As we've said now for several months, markets have got a little bit ahead of themselves. We've been bearish about government bonds for a long period of time. So none of that was a surprise. The extent and pace at which it happened, I think, was a surprise.
And the other main fact you mentioned at the start of this is China.
Yes.
Can you give us some more colour on what's going on there?
Well, we have felt, and we've said this for some time now, that China is going to slow down. There's a big rebalancing of the economy that's required. The economy at the moment is heavily dependent on capital spending, about 50% of GDP from that. That's not sustainable. We know there is surplus and excess capacity in lots of areas, and we need to rebalance more towards consumer spending. That's not going to be an easy process. And what we've seen is, I think, a more realistic approach from the new leadership that came in at the end of last year. They are cutting out conspicuous consumption. They have moved to tighten credit through the central bank, the People's Bank of China. And I think the perhaps most worrying event to investors in June was the extent to which the PBOC allowed interbank rates to move up very sharply. So liquidity was being drained quite significantly from the system in June, unexpectedly. At one point, we saw interbank lending rates go to 12%. Now that's exceptionally high, and I think there were lots of discussions around this, lots of sort of reasonably plausible suggestions, might have been seasonal and so on. I think the most important thing is that the PBOC, the central bank, was delivering a message to the banks that it had to rein in this huge growth we've seen in credit, which has been primarily through the so-called shadow banking system, wealth management products and things like that. There's been a huge creation of credit. Credit has gone from about 130% of GDP 4 or 5 years ago to 200% today. That has to be reined in. The PBOC delivered that message loud and clear towards the end of the month, it came in to provide liquidity to the markets. Things settled down a little bit, but I think the message is there. They want to rein in credit. They want to stop this excess credit creation, the lending which has pushed up property markets. And I think we will see, therefore, much slower credit growth as we go through this year. And of course, that is a further dampener to economic growth. So on the back of that, no surprises that commodity markets fell very sharply. Currencies that have been heavily dependent on the success of China in recent years. The Aussie dollar, prime example, is now down 12% so far this year, had a big fall in June. So a big correction going on there. And I think now the consensus view about Chinese growth is moving more towards the position we've had for quite some time, where we've said we think growth is going to be more like 6 or 7 than 8 or 9. If anything, that 6 or 7 may still be revised down, I think, as the year goes on from my perspective.
Sticking with GDP growth, economic conditions in the developed market, in parts appearing pretty reasonable now.
Yeah, look, I think there's a really interesting contrast going on. I mentioned the fact that equity markets had quite a sizable sell-off on the back of the Fed's announcement, which indeed they did, but developed markets for the month were only down about 2.5%, emerging markets were down about 6.5%. That continues a trend now that's been going on for the best part of a year. So far this year, emerging markets are down about 10%, equity markets. Developed markets are up about 8.5%, huge divergence. And I think that is reflecting to a degree the economic reality. Growth in the emerging world is slowing down quite significantly, not just China. Brazil, which is another huge emerging economy, is going through a very tough time. The currency has been very weak. Industrial production has turned negative year on year. The country has relaxed its controls on inward capital flows, which it only put in place a matter of 12 months or so ago. We're seeing quite significant social unrest in parts of the emerging world, Brazil, Turkey, Egypt, of course, very recently at the end of the month. All of those things are suggesting that growth in the emerging world is going to be on the weak side, whereas what we've been seeing from the developed world is actually reasonably encouraging. I'm not suggesting for a moment that developed economies are going to start to boom. That's simply not the environment we're in. But in the US, the numbers coming out have been reasonably good. And bear in mind, the US is actually facing the headwind of quite significant, quite serious fiscal contraction as a result of sequestration and the fiscal tightening earlier this year. It takes about 1.5% out of the economy in the first half of this year, yet the economy has still grown by a couple of percent or thereabouts. So house building is strong, and I think is going to continue to remain strong. Retail sales, consumer confidence has been strong. So the US looks set for, I think, reasonably steady growth this year. But the encouraging, I think, data that's been coming out is, first of all, from Japan, confirming that the Abe reforms, particularly fiscal loosening and very, very loose monetary policy, are beginning to have an impact. We're seeing quite good data come out of Japan. The economy grew by 4% in the first quarter of this year. Retail sales moving upwards, confidence is moving upwards. I think we'll have a good year in Japan. The UK, the recovery that we've talked about in previous months that was very fragile, is beginning to get a little bit stronger. The numbers coming out of the UK have been good from all sectors: services, manufacturing, construction. And I think we will see the UK economy actually performing quite well as we go through this year. Even Europe, which remains in recession, but even in Europe, the purchasing managers' indices that have come out in the course of the last month have actually been quite encouraging, at a 15-month high. So I think we'll see the developed world just steadily, albeit in a sort of fairly fragile environment, steadily begin to pick up a little as we go through this year, whereas the emerging world remains under, I think, quite a cloud.
Looking forwards then, we've got an interesting paradox between improving growth situation in the developed world. That increases the risk of tapering.
Yep.
What does this mean for markets, do you think?
Well, it's a very odd situation where good news on the economy, which is normally good news for markets, is actually being seen as bad news, because it means that the Fed will definitely will taper perhaps more aggressively. My suspicion is that the Fed, in its announcement in late June, was actually doing a little bit of testing of the market. How will the market react when we start to taper? And the message the market delivered was not very well. The market was very, very nervous. There was a sharp sell-off. And I think the Fed will therefore be pretty cautious about the timing and the extent to which it tapers. And remember, we're talking about tapering. It's not going to start selling these bonds back into the market. There's still going to be a pumping of liquidity into the market. It might only buy $50 or $60 billion a month rather than 85 in the first instance, but it's a tapering. The Fed also made it very clear that that decision, which is data dependent, is not preconditioned. It will depend very much on the way the economy goes in the coming months. So if the economy slows down, they won't taper. The other important point that the Fed made is that the decision on tapering is quite independent of the decision on the timing of the first move up in interest rates, and it still expects that in 2015. So we've still got a fairly long period ahead when interest rates are going to stay at zero. The other important point is that if you look at the other big central banks, Japan, we know what the BOJ is doing. It's going to remain ultra loose for as far as the eye can see. The Bank of England under new Governor Carney and the ECB under Draghi, I think are both moving to a sort of slightly similar policy stance to the Fed, where they're giving forward guidance to the market on how long interest rates are going to stay low for. And that's a very long period of time, a couple of years at least, if not materially longer than that. So I think what we've got is a situation where bonds have a problem in that they've been expensive. Their interest rates have been pushed down to very low levels by this ultra-loose monetary policy, by zero short-term interest rates. We know the next move in all this in central bank policy is for policy to be less loose, and of course the next move in short-term interest rates will be up. It's a long way away, but it will be up. So bonds remain to us an asymmetrical investment. You know, the downside in capital returns is greater than the upside from here still, despite this backing up in yields of about 100 basis points we've seen in treasuries. Whereas equities, I think, will benefit from slightly better economic growth. The corporate sector is in very good shape. This quite sizable sell-off that we've seen in equity markets over the past couple of months is presenting some pretty interesting opportunities, not the least of which are in sectors which were regarded as sort of almost like bond surrogates, such as utilities, infrastructure stocks, telecoms. There's some really quite good values that's re-emerged in the equity market. So we can see equities, having had this dip, performing better, albeit in a more volatile environment than perhaps we've seen over the past 12 months or so because of the data dependency of the Fed's decision on tapering. Whereas I think bond markets will remain under something of a cloud. So I think it's important in bonds to remain short duration, floating rate products where one can find them. Whereas in equity markets, I think the outlook remains actually pretty benign and pretty constructive.
Thanks, Glynn.